Good day fellow traders and value investors, and welcome back to another video. Today we continue our series Start with the A's, and we're looking at Qualcomm, a business with a moat and strong cash flows. But does that make it a Warren Buffett style compounder? Let's have a look. Qualcomm is a global leader in wireless technology, best known for inventing the foundation technology that makes modern mobile communication possible: 3G, 4G and 5G. The company operates through two main business segments: QCT or Qualcomm CDMA technologies. This is the product side of the business. They design and sell the chips and software for smartphones, cars and IoT devices. This segment generates the majority of their revenue. And QTL, Qualcomm Technology Licensing, this is the intellectual property side. Because Qualcomm invented so many essential wireless technologies, other companies pay them royalties to use those inventions in their own products. This segment is highly profitable with 72% margin. Qualcomm is currently executing a diversification strategy. While they started in mobile handset, they are aggressively expanding to automotive and IoT to reduce their reliance on the smartphone market. Qualcomm took a massive $5.7 billion one-time tax charge this year. This is due to the new US tax legislation, which changed how they value deferred tax assets and signaled they will be subject to new corporate minimum tax starting in 2026. If you strip out that one-time accounting event, their non-GAAP net income actually grew 15% to $11.5 billion. The core business isn't collapsing, it's getting more profitable. Qualcomm continued to generate strong operating cash flow, and management returned a significant amount of capital to shareholders, roughly $8.8 billion in buybacks and $3.8 billion in dividends in 2025 alone. And this brings us to the most important fundamental question for Qualcomm today: Apple. Apple is gradually moving towards using its own modem technology, which means Qualcomm is likely to lose a meaningful portion of high-quality revenue over time. Estimates suggest this could represent several $billion per year once fully phased in. On this article in Future Room, you can see that it can go as much as 7-8 billion by 2028 or in 2028. This won't happen overnight, but it's directly affecting future revenue mix, margin and investor confidence. The key question is not whether Apple is a headwind, it clearly is, but whether Qualcomm can replace the profit through premium Android, automotive and IoT earnings. And that balance between cash flow strength and transition risk is what defines Qualcomm's fundamentals today. Let's look at the fundamentals or financials in trading view as well. We'll first look at the revenue. We can see there's double-digit growth revenue over the last few quarters. Net income, double-digit growth with a big drop in Q4 2025, and that's mainly due to the 5.7 billion tax charge. Switch to annual. We can also see that the revenue has been growing steadily. It's currently at 44 billion. Also, obviously, if we take into account that lost revenue from Apple or the potential lost revenue of about 7-8 billion, that will make it slightly lower. Net income is up and down, and that's mainly because of their taxes. We can see how the taxes have been increasing slowly, and also because they spend quite a bit on R&D. You can see the research and development has been at 8-9 billion as well. Change to the balance sheet. We see they have a total of about 50 billion in assets and about 30 billion in liabilities. We can see that they have a healthy cash position of about 12.5 billion and the net debt is at 3.17 billion. We'll switch to statistic and change it to annual straight away. We can see that the company is currently selling for a PE of 35.51. If we look in the past as well, it's been selling for a PE of 10, 17, 16, and that's important for our intrinsic value calculation. Net margin was pretty healthy over the last few years, and obviously the hit by the tax in the current year in 2025. Qualcomm has a current ratio of 282, which is pretty healthy. It means that they have 2.82 cash and short-term assets for every dollar they owe in the next year. They aren't just surviving, they have a massive cash cushion to keep the R&D spending high, regardless of what the economy does. And finally, debt to equity of 0.74, which is slightly above what I like it to see, of 0.5, but that means that they have enough cash to pay for those buybacks and for the dividends without getting into debt. So here's the bottom line for the fundamentals. When you strip away the tax headlines, Qualcomm isn't a company in trouble, it's a cash flow fortress that's currently on sale. But there's a reason the market is giving us this discount, and that's the Apple risk. So now let's have a look at the intrinsic value using the three calculators: Warren Buffett, Phil Town and Peter Lynch's calculator. We can see that the stock is currently overvalued according to all three calculators. When we use Warren Buffett's calculator, it mainly takes into account the current and old book value per share, and according to it, the stock should be valued at about $41. Using Field Town, I use a more optimistic growth rate of 10%, even though the consensus is about 3% over the next 5 years. But anyways, I use 10%, and even so, according to Field Town's calculator, the stock should be valued at $55 per share. And then we get an overvalued rating using Peter Lynch's calculator, which also uses PE growth, and then for the growth we use the 10% as well. So there you have it, a range between $41 and $55 per share using the three calculators. And for the three case scenarios, I use Qualcomm's ability to replace Apple's modem profit as the key driver, and I used these multiples because as we've seen in the fundamentals, Qualcomm was selling for a PE of about 10, 12 in the bear years. I use 17 because Qualcomm often sells for mid to high teens in normal conditions, and I use the PE multiple of 22 for the bull case because it's still not AI hype expensive, but higher than Qualcomm's recent norms. So in a bear case scenarios, if we see EPS growing at 2%, Apple modem transition accelerates, Android, automotive and IoT growth isn't enough to compensate, you can see EPS being at about $5.53, and the stock price could be at $66.38 per share. In a base case scenario with EPS growing at 8%, Apple remains a headwind but not a shock. Automotive and IoT scales steadily. We could see EPS going to $7.36, and the stock could be selling for $125 per share. Still a drop, as we can see. And in a bull case scenario with EPS growing at 12%, automotive and IoT scale faster than expected. On device AI creates a new demand cycle. We can see earnings per share going to $8.83, and the stock could be selling for $194 per share. And I use current EPS of $5.05 as they reported, rather than how they calculated without the tax. Putting it all into a probability weighted table, we can see that we can get a negative return in a bear and a base case scenario, and positive return only in a bull case scenario. Adding it all together, over 5 years we can get a negative 26% return from Qualcomm if we buy it at current level, and that will make it compounded about 6% over a year. Plus 2% dividend is still a 3% negative yearly return from Qualcomm if we buy it at current level with current earnings. But here's the twist. If you use $12 per share as the EPS, as the management wants us to believe that it is, or as it would have been without the tax, we can see that in a bear case scenario we can get a price of $158 in 5 years, in a base case scenario about $300 per share, and in a bull case price of about $465 per share with the same conditions and the same growth. And then if you put down those numbers into a probability weighted table, we'll see we can get a 12% return from Qualcomm plus 2% dividend. That's about 13-15% from Qualcomm. So there you have it, 3 scenarios multiplied by 2. I use fundamentals to decide what stocks to buy, and I look at the technicals to time my entries. If you look at the chart for Qualcomm, there's a few things we can see. I'll zoom out a little bit. We see that the $100 per share was a resistance area, a little bit of resistance back in 2020. It pierced through it, rallied all the way to about 175, where it found further resistance. It dropped from it, came back to 100, and spent quite a bit of time around $100 per share. It then bounced off of it, and it rallied all the way to about 200, 220. Where it found resistance, sellers rejected this level, and then the stock crashed till about 120. Zooming back in, we can see that the stock is currently trading at around the $170 resistance area. We can see that the ATR dots are below the candlestick, below the price, indicating the momentum is upwards. We can see the moving averages pointing upwards as well, and we can see that the MACD-V and the signal lines are creeping up. MACD-V is still below the 50%, which indicate that the momentum, there isn't strong momentum behind the stock yet, but it could as well come after the better earnings in February. For me, from the technical perspective, I don't have any signs to or any signals to enter the stock, to open a position, a speculative, and I don't like the probability of negative return over the next 5 years. So, is Qualcomm Warren Buffett style compounder? Qualcomm is not a speculative trade. It's a high quality business with a durable technology moat, strong cash flows, and a licensing engine that provides real downside protection. However, at today's prices and cycle position, it's also not a classic buy and forget Buffett stock. Customer concentration, cyclicality, and the Apple transition mean this is a business that rewards discipline and timing, not blind conviction. This is not a stock to chase, but it's one to watch closely as the fundamentals and price continue to improve. If you enjoyed this analysis and found it useful, hit the like button, consider subscribing, and let me know in the comments what stock you'd like me to analyze next on Fundamentals in Motion. Thanks for watching.